Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Israeli Prime Minister Benjamin Netanyahu says a deal to pause the war has now been finalised. Government officials will gather later today to sign off on it. Beijing's pivot to stimulus mode helps China meet its official 5% growth target for 2024, but the property slump and US trade tensions continue to loom. And a Bloomberg scoop, Rio Tinto and Glencore have been discussing a potential combination in what could be the biggest mining deal in history. Good morning, happy Friday. European futures looking to build on the solid picture yesterday. The gains came through more than 0.9% added to the European stock index. The US close was mixed. A little bit of softness coming through, particularly for the Nasdaq 100. But there is a bit more optimism in the session today, although there are arguably fewer catalysts for these markets. Currently, European futures looking to gain just 0.1% at 5,121. FTSE 100 here in the UK looking to add 38 points. S&P futures stateside currently looking to add 0.2% after the modest softness that we saw yesterday. Nasdaq 100 futures looking to add 47 points, up 0.2%. Again, ending the session Thursday in negative territory for the Nasdaq 100. We'll flip the board and have a look at what is happening in terms of the US Treasury story. And of course, the pound remains in focus for us, as it has been through this week. The US 10-year currently yielding you 461. We did hear comments from Chris Waller of the Fed speaking to CNBC saying they could still cut in the first half of this year. Again, if the inflation data aligns with what they're looking for. 122 still on the pound, currently down 0.2%. Brent at $81 a barrel, set for 4 or possibly 5 straight weeks, at least 4 straight weeks of gains coming through for oil. The strength is there, solidly above $80 a barrel, currently looking to add 0.4%, adding 0.4% so far in the session on Brent. And Bitcoin back above 100,000 on new lines crossing around the incoming Trump administration, how they may prioritize the crypto space once, of course, Trump is inaugurated come early next week. 101 currently on the major cryptocurrency, up 1.2% so far in the session. Let's flip the board and have a look at the Asia picture as well. The China data certainly in focus. They got that 5% growth number. The stimulus towards the back end of 2024 coming to play then and proving supportive, even as we know the real estate sector remains in a deep slump. Broadly across the Asian picture, MSCI Asia Pacific currently down 0.2%. CSI 300, mainland China then up 0.4. The Nikkei over in Japan under a bit of pressure. Japanese stocks down 0.5%. And the yen remains, of course, in focus as expectations continue to build that the BOJ will go with another hike next week at that meeting. 155 right now, dollar, Japanese yen. Currently the dollar up versus the yen, 0.2%. Let's get to the Middle East then. The major story and confirmation coming through from Israeli Prime Minister Benjamin Netanyahu that a deal to return hostages held in Gaza has been reached. In a statement, he said government officials will gather later today to sign off on that deal. Netanyahu had previously accused Hamas of reneging on parts of a ceasefire agreement, risking its completion. The Gaza-based militant group says it remains committed to the deal. For more, let's cross over to Tel Aviv. Standing by for us is Bloomberg's Oliver Crook. Ollie, we've been hearing from the Prime Minister of Israel. Does the support of Netanyahu, is it enough to get this deal across the line, given his coalition partners and some of their views on this?
Yeah, so listen, Tom, this is going to be one of the sort of key factors here within Israeli politics about kind of how the war is continued or is stopped. And this is to do with the fact that this coalition right now is being held together by the Likud party, Benjamin Netanyahu's party, and some very far right-wing parties who basically want to continue to prosecute the war, who say that basically pausing it or halting it at any point before Hamas's total and complete eradication really would basically signify a loss for the Israelis. That being said, it seems as if Benjamin Netanyahu has seemed to have got enough of the concessions from Hamas. There was that sort of last 24 hours. It was sort of not clear whether or not this would go over the line. We understand this had to do with details about prisoner swaps and who had basically veto rights about who would be released from Israeli prisoners being held that are Palestinian. That seems to have been resolved. Whether or not the rest of the cabinet of Benjamin Netanyahu gets behind this is not yet known. Basically, this will be held at the Security Cabinet meeting a little bit later today. There may be some sort of conditions that will be put on by the right wing, basically a sort of forcing Benjamin Netanyahu to commit to continue the war after 6 weeks. Again, all of this is sort of up in the air right now, but the reality of the situation here in Israel is that there is an immense pressure to get these hostages back. There is an immense pressure from the Israeli public to basically go forward with this ceasefire and get these hostages back. And if there is a sort of hampering of that, it is possible also that, A, the government could rule in a sort of minority status if some of these far right-wing parties step out of the government, and also it would probably gain support from other lawmakers that are more on the sort of central side of Israeli politics.
Okay, so Ollie, with all those caveats and potential outcomes, if they get this deal signed off later today in Israel, what are the next steps? What are you looking for on Sunday and beyond Sunday?
Yeah, Tom, I mean, of course, it's to say it's very sort of historic and absolutely huge. I mean, this would be a sort of meaningful ceasefire. We're talking about 6 weeks, and this is supposed to be a roadmap, basically, to end the war entirely. This is the first of 3 phases of basically how this has been envisioned, as laid out by President Biden and sketched out by a number of the other negotiators that have been in Doha, from the Egyptian side, from the Qatari side, from the U.S., Israel, and Hamas, all trying to sort of work towards this. The mechanics of how this works is on Sunday, you will get, if it goes into power, you will get the official ceasefire. You will get no more fighting within the Gaza Strip. You will get the initial release of some hostages. We understand there will be 3 hostages released, 3 women, and then you'll get a few hostages released every sort of few days over that period of time. As that happens, there will be release of prisoners being held by the Israelis. We understand that there'll be more than probably 1,000 of those that will be released. And as that happens, Tom, what you have critically is you have the Israeli military that will basically withdraw from the populated areas within Gaza. They'll still stay a large force within the Strip, probably to the sort of east side of the Strip, but they will begin to withdraw from the populated areas. And of course, Tom, critically, this will also mean that humanitarian aid will flow through in much, much higher volumes into the enclave of Gaza, where more than 45,000 people have died since the beginning of the war. And obviously, as we've been reporting, and everyone's been reporting for the last year and 3 months, the conditions, the humanitarian conditions, are extremely dire. So absolutely critical to get that aid in, hopefully over the next few days.
Bloomberg's Oliver Crook on the ground for us in Tel Aviv. Thank you for that important update as we look ahead to Sunday then. To the macroeconomic data out of China right now, because the economic expansion did meet the government's annual 5% target last year. We've had that confirmed today. That's as a bold stimulus push turbocharged activity in the final quarter of 2024. For more, let's bring in Bloomberg's James Mager in Beijing. Always has his finger firmly on the pulse of this Chinese economy. What stood out to you, James?
I think the things that really sort of stood out to me was that you saw the continuation of the story we've had all year, which is a strong industrial side of the economy, really strong exports, and still pretty lackluster retail consumption side of the economy. Consumption was less than half the pace. The growth in consumption was less than half the pace we saw in 2023. But you did see industrial production pick up, especially in December, and we saw that in the PMIs earlier. And that's partly due to the stimulus domestically, and it's also partly due to the huge amount of exports that China shipped out last year. $3.6 trillion worth of exports last year, really driving growth. And the second thing that stood out to me is, don't look at the 5% real GDP target or that they met. Look at the nominal GDP value. What's that telling you? It's telling you that we had deflation last year, second full year of deflation. The GDP deflator was about minus 0.8. And I think going forward, that's really the more important number to look at than the inflation-adjusted growth numbers. And so, yes, that they were able to meet their target, but underlying that, there are still a lot of problems. Prices are falling, company profits are falling, wages are falling. People are not, confident about this economy. And what I really think you saw last year is you saw government stimulus coming through, government spending coming through, helping the economy, and then exports coming through and helping the economy. Looking ahead, Donald Trump comes in on Monday. If he puts tariffs on Chinese exports immediately or at some time in this year, that's really going to take away from that export driver, and it's going to be the government that has to step up and do even more to fill that hole in the economy.
James, is it your understanding, is it your feel on the ground there, looking at the data, that at least this is an economy that's got over the worst hump? That they've gotten over the worst, there are the challenges coming up, but the hard work's been put in now? Or is that not the right way to think about it?
I think it's premature to say that. I think you look at the housing sector, there was definitely a pickup in the last quarter. We saw prices sort of starting to bottom out. We did see a slight pickup in sales in December and November. And I think that's really due to the stimulus measures and the deregulation of the housing market that was announced from the end of September through to the end of the year. So definitely that was having an effect. But sales still fell for the year. You saw construction falling for a fifth year in a row. Construction was down 20% this year on year, and that was on the 2023 when it also fell more than 20%. So you're still seeing massive, slumps in the housing market, and that is flowing through to the industrial sector, production of steel, and all these other kinds of things. So it is an improvement. But there's still definitely not out of the woods, and you really do need to see a turnaround in household and in housing prices for people to feel more confident and for people to really start spending again, especially if absent, unless the government does a lot more. If the government sort of continues to do what they're doing at this level, will we really see a big jump in consumption and confidence to consume? I think that's doubtful.
Okay, still big questions around the Chinese economy. James Mager with the details, the analysis, always excellent. Thank you. Joining us out of Beijing to a major deal now, and this actually ties to China because Rio Tinto and Glencore are said to be discussing combining their businesses. If successful, it would rank as the largest ever mining deal and create a behemoth to rival long-standing leader BHP. I tie it to China, of course. These companies are shipping a lot of iron ore, particularly to that economy. Let's get more in terms of the details around this scoop and bring in Bloomberg's Alain Hunt. Paul, what is behind this potential deal, this potential tie-up between Rio and Glencore?
I mean, in the space of about 12 months, we've seen two massive potential deals come to light. Last year, of course, there was BHP and Anglo-American. Today, from our London bureau, we're breaking that Rio Tinto and Glencore are in discussions. We don't know, and I have to preface this, we don't know whether those discussions are live at this moment, but we certainly know that discussions have been had. As you said, this would be one of the largest, if not the largest, merger or deal in the mining sector in history. Rio Tinto is valued at $103 billion. Glencore closed at $55 billion yesterday, and BHP is $126 billion. So we're looking in excess of $155 billion in this sort of a merger, and that knocks BHP from first place as the major miner globally. At the heart of this story is copper. It's the key metal used in batteries and in electrification, amongst other purposes. And it's an area where both major companies, BHP and Rio Tinto, have identified huge future growth. So last year, BHP went after Anglo for copper assets. This year, these discussions that we've been hearing, it's Rio Tinto chasing copper from Glencore. At the heart of it, there is one particular mine that featured in both of those transactions, and that's Collahuasi, which is a massive, high-quality copper mine. So it's all about quality. It's all about resources of copper.
Okay, Dr. Copper is central to this. What are the potential hurdles to getting a deal across the line then?
Well, deals of this size and in the mining industry are never smooth sailing necessarily. There is a level of complexity to this. I mean, the first thing that jumps to mind is that Rio Tinto divested its entire coal portfolio by 2018. If it were to merge with Anglo-American, it would inherit a massive amount of high-quality coking coal. Does it really want to get back into coal? Many analysts are saying no. At least the analysts I spoke to today said they don't see that that's entirely likely. That would mean that huge coal portfolio would need to be spun off or kept with Glencore's current owners and shareholders. The second is this geographical spread of assets. This is another thing that I've been talking with analysts today about. Glencore has a lot of assets in, say, Africa. Rio Tinto doesn't really want a presence where these assets are. And that is a question that would need to be resolved. And then thirdly, I guess, is the quality of all of Glencore's mines and assets. I mean, it's got over 130 different mines. Some of them, or many of them indeed, lie in the third or fourth quartile in terms of quality. That means that every now and then they get shut down when there's a mining down cycle. Rio Tinto, on the other hand, is only looking for tier 1, tier 2 assets. And that's really where these copper assets of Glencore's are. That's where they sit.
OK, Bloomberg Metals and mining reporter Paul Elaine Hunt on some of the complexities around what could be one of the biggest deals, the biggest deal in mining history. Paul, thank you. Coming up, Treasury Secretary nominee Scott Bessent expressed full alignment with President Trump's economic goals at his Senate confirmation hearing. We're going to get more details next. Plus, after the UK unveiled a wide-ranging plan to become a world leader in AI, we're going to speak with Richard Anton, the co-founder of tech company Ox. That's at 6:40 a.m. on investing around AI. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Fed Governor Chris Waller says the US could lower rates again in the first half of this year if inflation data continues to be favourable. Treasuries rose, as Waller told CNBC he wouldn't rule out a cut in March. Let's dive deeper into the market reaction with Bloomberg's Valerie Teitel. Valerie, we've come a long way since the start of this week to where we are now in terms of moves in the bond markets. Have things settled at this point? How do the markets interpret these comments?
Look, it was interesting to see the fact that those Waller comments just reminding us that the Fed could cut sometime in the next 6 months led to such a big rally. But remember, it was only Tuesday we were talking about the possibility of the Fed hiking this year. It just shows that the market got a bit over its skis in terms of pricing out those cuts, and now we've gone to price those back in. We've seen a big belly-led rally on the Treasury curve so far this week. The last 2 days has seen that 5-year sector outperform on the curve. Biggest move, actually, since July 2023. It's rallied 14 basis points on the curve. So a big repricing, all going back to just reminding ourselves that, look, if inflation continues to fall, we could see a Fed cut. Waller there yesterday reminding us that the March meeting is very much a live meeting. He wouldn't rule out a cut then. He also said if the data continues like this, we could see 3 or 4 cuts possible from the Fed for this year. That would be backing a quarterly pace of cuts. So for them, cutting in March would very much align with that. He did say some also interesting comments weighing into the politics a little bit, Tom. He did say he wasn't necessarily worried about Trump's policies leading to inflation. So this is yet another a member of the Fed coming out and saying that they're not necessarily worried about those tariff policies reigniting inflation later in the year and in some way coming up against these Fed cuts that they've penciled in.
And that is a key uncertainty, clearly, the policy. And Fed officials have increasingly started to kind of factor that into their thinking, haven't they? We've been hearing from Treasury Secretary nominee, at least, Scott Bessent, arguing for extending these tax cuts, warning of potentially an economic crisis if they are not. Let's take a listen to some of his answers on other policy issues.
The United States is not going to default on its debt if I'm confirmed. The FOMC should be independent. I will be 100% on board for taking sanctions up, especially on the Russian oil majors. Americans are barreling towards an economic crisis at year end. If we do not renew and extend, then we will be facing an economic calamity. On CBDCs, I see no reason for the U.S. to have a central bank digital currency. I firmly believe that if confirmed, and with your counsel and support, we can usher in a new, more balanced era of prosperity.
OK, so none of the drama, or at least very little of the drama that we've had with former scrutiny of some of these nominees in the early part of this week. He seemed to have kind of broadly sailed through this nomination process. It's not fixed, of course, yet. But in terms of the scrutiny and questions he got, appeared to perform quite well. What were the key takeaways for Wall Street?
Well, for the Treasury market specifically, it was notable there was no discussion on Treasury issuance. Now, we were worried about this because in the past, Scott Bessent has been a very critical voice against the previous Treasury Secretary, Janet Yellen, for issuing so many T-bills when she could have extended duration and termed out the debt. So thankfully, there was no comments about that. The long end of the curve, we know, has been very vulnerable recently. That was one, catalyst we could see for a further steepening of the curve if he did talk about terming out the Treasury issuance. So we have to await the quarterly refunding announcement, which comes at the beginning of February, for any updates on that. But he did talk about tax cuts, calling them the single most important economic issue facing the U.S., very much in line with Trump on that manner. He also did back Fed independence. He was asked about that, saying it's a good thing that the Federal Reserve, that the FOMC is independent from government. He also reiterated that tariffs are a useful tool. He does not see them as inflationary. So again, going back to the comments that we've heard from Fed officials, backing the fact that he does not see them as inflationary, and he sees them as a tool to combat unfair trade practices. And to that extent, Tom, he had some pretty scathing words to say about China. Take a listen.
China is the most unbalanced economy in the history of the world. They are in a severe recession/depression. They may have minus 4% disinflation, and they are attempting to export their way out of that as opposed to doing the much-needed internal rebalance.
All right, so that was Scott Bessent being very critical of China, trying to export their way out of the slump, dumping cheap goods worldwide, or at least that's how he sees it. He seems like he would be a supporter of Trump, of tough tariffs on China.
Yeah, really interesting comments on China. On that point, seeming to align with Treasury Secretary Janet Yellen, who has been on the ground in China as well, pushing for that focus on the domestic economy and warning about a flood of exports out of China into other markets. Bloomberg's Veli Teitel, thank you very much indeed, breaking down what we've been hearing from potentially incoming Treasury Secretary Scott Bessent, of course. Coming up, Wall Street's 6 largest banks returned $100 billion to investors last year, the most since 2021. We're going to discuss those blockbuster earnings next. This is Bloomberg. Welcome back. Bank of America's fourth quarter profit has exceeded analyst estimates, boosted by high investment banking fees and strong net interest income. Morgan Stanley, meanwhile, also seeing fourth quarter profit more than doubling. For more, let's bring in Bloomberg's Charlie Wells, who's been following all the bank earnings for us. What stood out to you, Charlie, from these latest numbers?
Yeah, Tom, it really has been a week of superlatives for Wall Street's biggest banks. JP Morgan was the first bank in U.S. history to clock $50 billion in annual profits last year. Goldman Sachs' equities trading desk, they had their best quarter on record. And we also heard Citigroup is going to be buying back $20 billion in shares. And now that gets at a really interesting trend that we have been reporting on here at Bloomberg, which is that last year those large banks returned $100 billion in buybacks and in dividends. And that really speaks to something interesting that we've seen in the banking sector all throughout earnings season, which is this idea of confidence. So in order to buy back shares, in order to return dividends, in a lot of ways, these banks have to be confident, particularly on that buyback front, in the sense that they need to feel comfortable with the amount of capital that they have. They don't necessarily need to deploy it internally. They can return it to shareholders. And that, of course, really helps boost their share prices going forward. And this is something that we've been really honing in on in this earnings season as we enter what seems to be a new era in politics, but also on Wall Street. It seems like these banks are increasingly confident about capital. They are very confident that that Basel III endgame that they had been campaigning against this requirement to hold more capital, they may not need to do that, and they can in turn return that to shareholders. So we're going from a period of confidence into a period that seems like that will just continue, and they'll be able to pay that back.
Charlie Wells, thank you very much indeed on the dividend and share buybacks coming through from the banks, and what it could spell for the latest of this year. Coming up, Reform UK's Nigel Farage praising Elon Musk. We've been sitting down in conversation with the leader of that party. We're going to bring you that interview next. This is Bloomberg. Good Friday morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London, and these are the stories that set your agenda. Israeli Prime Minister Benjamin Netanyahu says an agreement to pause the war has now been finalised. Government officials will gather later today to sign off on the deal. Beijing's pivot to stimulus mode helps China meet its official 5% growth target for 2024, but the property slump and US trade tensions continue to loom. And a Bloomberg scoop, Rio Tinto and Glencore have been discussing a potential combination in what could be the biggest mining deal in history. Let's check in on these markets then. European futures pointing to modest gains of 0.1% after rallying yesterday by around 1%, lifted by the earnings story, lifted by a slightly more benign picture on inflation. The FTSE 100 here in the UK looking to add 42 points so far in the session. S&P futures pointing high by 0.2% after dropping a similar amount by the end of the close yesterday. Nasdaq 100 futures looking to add 47 points after falling around 0.7% again by the end of the Thursday close. Let's flip the board and have a look at what's happening with the Japanese yen, but also the Treasury space as well. US Treasuries relatively stable so far in the session. Towards the end of the week, we have seen a bid, as Valerie Teitel was talking us through, around the belly of the curve. 14 basis point move lower in yields on the 5-year. The 10-year currently yielding you 4.61. The pound remains in focus at 1.22. Further softness for the currency, down 0.2% in the session. Brent's set for 4 straight weeks of gains, above $81 a barrel, up 0.4% in the session. And Bitcoin trading above 101,000, up 1.3%. Some lines crossing on Trump looking to make this a policy priority in terms of the focus on crypto. Now, Brexit architect and Reform UK party leader Nigel Farage says Elon Musk is a force for democratic good and a hero, but should not be seen to be dictating what the US Treasury Department should do. Here's some of our interview.
In America, billionaires have more influence over society than we do in Britain. There's no, culturally, there's no question about that. Musk is a very powerful figure, of that there's no doubt. But I also think he's a hero. I mean, if you think back to the last election in 2020 in America, where the Hunter Biden laptop was there, the evidence was clear of criminality, for which he's now been convicted of 1 or 2 things. The evidence was, all sorts of things were there that deserved to be in the public domain, especially his father's close relationship and telephone calls with various companies.
That's a separate issue.
No, it isn't. No, it isn't at all, and I'll tell you why.
Yeah.
All the social media channels forbade any conversation about that subject. The Americans had an election with no debate on this issue. Musk has come along and bought Twitter, albeit for quite a high price. And free speech is coming back to America and the Western world. You've even seen Meta in this week. An extraordinary U-turn that has been made. So Musk is a force for good in terms of open democratic argument. When it comes to power and influence, I think the important thing is he mustn't be seen himself to be dictating what the Treasury Department do. And that is important.
A lot of people would disagree with the point around, freedom of speech. Particularly the Europeans are deeply concerned about misinformation. The Elon... hang on. The
anything
Elon
we
Musk
disagree with is misinformation. I know. Yes. We must all support globalism. We must all support open borders. If we don't, it's misinformation. I don't buy it.
OK, that, of course, was Nigel Farage, leader of the UK's Reform Party, speaking on the Bloomberg UK Politics podcast to Caroline Hepker, who joins us now around the studio, around the set, of course. It was a wide-ranging interview, Caroline. What specifically, there was a number of topics then you touched on.
Yes. What
specifically did he have to say? I mean, this is a key question, isn't it? The relationship. He knows Trump very well, and he's become slightly closer to Musk, even if they've had their recent rupture. What is his view in terms of the Trump-Musk relationship going forward?
I thought it was very interesting that he's a little bit more cautious on Elon Musk after that row around the supposed, perhaps rumoured $100 million donation to Reform UK, Nigel Farage's party here in Britain. So he was talking, and he had a view on the world's richest man and what his role in the Trump administration should be, i.e. that he shouldn't be seen to be dictating policy within the Treasury Department, which obviously would be Scott Bessent, potentially his role. I think he he didn't sort of specifically have a view about Trump and Musk's relationship together, but he was interesting on Doge, for example, that if that comes through, that if Elon Musk will focus on this department, it's not really a department, but on government efficiency within the US, that is going to be a major fight. For example, here in the UK, if you have a lot of AI replacing humans in terms of the work that they do. I think essentially it's taken Nigel Farage 30 years to become an MP here in the UK. He's now got 5 MPs in Parliament. He's clearly trying to move to the right, to take the ground that has been held by the Conservative Party in this duopoly of power for 100 years in Britain between Labour and Conservatives. Can he do it? He has advertised his closeness with Donald Trump. What are the real tangible benefits of that relationship potentially for Farage and for the UK as a whole? And then the other wide-ranging discussion points that we had were around the Reform UK's economic agenda for the UK. They obviously delivered that in a manifesto, a contract with voters before the last general election. The numbers don't reveal that much. There's not that much detail about what Reform UK's actual economic policies would be for Britain. How are they different, let's say, from Liz Truss? We had a whole discussion about that. And I think those are still some of the questions that Nigel Farage really needs to answer.
You also kind of tackle some questions around the City of London and what he would do here, particularly in terms of talent and immigration, which was interesting. Is this someone who is softening his stance? What are his views on the City of London, first of all?
Well,
he was a trader at one point.
He absolutely was, yes, and he made that point that. His party he says, is non-sectarian, non-racist, but it does seem to be that he is softening his stance on immigration, talking about how he is in favour of high-skilled immigration, particularly for the success of the City of London. That is his pitch now, essentially. But it's also about what skilled workers means, and other political parties within the UK have tried that before unsuccessfully. It is costly to try to return people who might come to the UK elsewhere. We've seen that in the UK-Rwanda policy, in the Italy-Albania policy. So it's not that there isn't consensus on limiting immigration in the UK. It's actually that nobody's been able to deliver it. Would Farage be any different?
Let's listen to one of his answers on that topic. Let's play the soundbite.
If we want the City of London, where we're sitting right now, if we want our tech sector to be a world leader, if we want to turn this place into one of the crypto trading centres of the world, all those things, there's a lot we can do with British people, but we will need some highly skilled people from other parts of the world. I have no problem with that at all.
So that was Nigel Farage commenting then on immigration. As you say, kind of softening his tone to some extent on immigration, particularly when it comes to the need for talent in the City of London and technology. Why do you think he's moderating on that? And what else stood out to you in terms of his views, particularly on the economy and the City of London? Well,
obviously, in terms of the vote share that he got in the election last year, that was largely taken from Conservative voters. So though he wants to appeal to those. Not that he's not trying to get more left-leaning voters either. I mean, there were some typical sorts of jibes. He talked about the Chancellor Rachel Reeves being Rachel from accounts. So he's also trying to cause problems for Keir Starmer and the government here. But I think the other really big takeaway is that he is offering sort of baubles, as it were, benefits from the relationship that he has with Donald Trump, saying that we can negotiate our own trade deals. This has been a really important point for Britain, that we wanted a UK-US trade deal. That's never really happened. He's saying that there are prizes on offer. Okay. If the Prime Minister wants to have a reset with the European Union and get closer to the failing European Union, it's going to be very difficult. But he's saying, with the right government, actually, that there would be sector-specific trade deals for Britain with a Trump administration. So he's sort of dangling some tantalising benefits.
Rachel from accounts, a little bit harsh. Colin from accounts, very funny, though. Caroline Hepker, thank you very much indeed. A wide-ranging interview, of course, with the leader of the Reform UK Party. You can, of course, listen to the full interview on the Bloomberg UK Politics podcast. Download that and subscribe it from wherever you get your podcast. Now, earlier this week, the UK unveiled a wide-ranging action plan for AI, sticking on the topic of technology and artificial intelligence. One of the aims, expanding the country's computing capacity 20-fold by 2030. My next guest says the UK and Europe are ready to seize the opportunity to lead the AI revolution. Richard Anton, co-founder and general partner of Ox, joins me now with a deep experience in terms of investing in the space, particularly around SaaS, so software as a service. Richard, thanks for joining us in the studio. What did you make of this AI strategy? There was we had the CEO of Synthesia on. He said he welcomes it. He thinks the UK is well positioned to be a real powerhouse in AI and technology. Others have said there's not enough detail in terms of the spending. There's not enough detail in terms of what they can do for talent, for data centres, for the energy component. What did you make of it?
I think it's good morning. I think it's a great rallying cry, a moonshot rallying cry for the UK to be a leader globally in artificial intelligence. It sets a great target, and I think that it's a great sign of positivity about the space and the opportunities, which are very real.
Okay, is there enough detail there to convince you that this is a government that is really committed? How much money do you think they should be putting forward? How seriously should the spend be on everything from data centres to compute to getting talent?
I think they should be directing government procurement towards AI, particularly towards entrepreneurial companies in AI, and moving government procurement away from large companies, think Fujitsu and Horizon, towards companies like Synthesia that will increase efficiency, that will help us cut NHS waiting lists and so on. So I don't think it's about more spending, it's about directing government procurement.
Okay, if we step back from the UK and look more broadly at how AI has evolved and that theme has evolved, particularly through the lens of an investor like yourself, what are the key trends that you're looking for in 2025?
AI is going mainstream. So there was a lot of dabbling. That belittles it, but there's a lot of work on foundation models, whether it's OpenAI or Anthropic or other companies. Fundamental technology building blocks being put in place, AI data centers, NVIDIA chips, cloud providers, all of that's in place. And applications have been limited for AI. We all use ChatGPT, but there haven't been a lot of business applications. Those have started in 2024, and they're going mainstream this year.
Do you think we get that killer AI app this year, then?
I think there'll be multiple killer AI apps this year, whether it's in legal contract review and contract creation, whether it's in machine maintenance, AI helping humans service and maintain machines, whether it's in video processing. I see multiple areas of apps being created.
And your focus is on SaaS, or software as a service. When you look across your portfolio of companies, are there any out there in that portfolio that you kind of look at and think you're going to get gobbled up by this AI revolution? I mean, some may end up leading, but some are clearly going to be vulnerable.
Yeah, some will be vulnerable, but the most agile ones are adopting AI and retrofitting AI to their processes. So in general, entrepreneurial companies are able to do that.
In terms of diffusing this technology, what do you see as the key bottlenecks right now?
That's a good question. I think it's completing the product so that customers can be confident that the product is going to work. It's going to work predictably. It's going to work without hallucinations, which are very dangerous.
And how, in terms of raising capital right now, particularly in the space in which you operate, how much of that is being directed? How many of your investors telling you to say, we just want this to be funneled towards AI applications versus other parts of the space? What are you hearing in terms of your investors, their willingness to step up and spend? Are you raising more this year?
As a venture investor, I'm always raising capital.
Are you opening new funds?
Yes, we're in the process of doing that. We're planning new funds.
Yeah.
So investors are interested, in particular, in enterprise AI and cybersecurity. They find those areas very interesting. But for the most part, they'll follow where growth is, and there's growth across these sectors. So they're interested.
Okay, the interest is there. Richard, thank you very much indeed. Maybe a focus on cybersecurity as well, and how AI ties into that. Richard Anton, co-founder and general partner of Ox. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. Happy Friday. Now, after a turbulent start to the year for UK markets, to say the least, let's get some analysis with Modupe Adegbembo, economist at Jefferies, with thoughts and insights on this UK economy and how things have adjusted just in this week alone. So, looking back on the week that was, then, Modupe, where do things stand? So the pressure on UK assets seems to have eased, at least in the last couple of days. Is the route that we saw in the early part of this week now in our rearview mirror?
I think it's definitely too early to say it's in the rearview mirror. I think UK assets will take this kind of relief rally that they're seeing and we'll take what we can from it. But what I know is that looking at the data, especially on the inflation side, a lot of the challenges are still not fully behind the UK. I think there are reasons that we actually think some of the reaction in markets maybe was too extreme. So, for example, when you look at market pricing, I think that shifted too hawkishly. So we're seeing a bit more of a moderation. But when you think about the fundamentals of the UK economy, questions of stagflation and whether we have fiscal sustainability, I think all of those questions still remain and they're still unanswered, essentially. And therefore, I don't think we can really say this is over. OK,
they're unanswered, but I want to push you on your views on some of those shortly. But before we get there, just on gilt yields specifically. So the 10-year yield, just since September, is up about 90 basis points on the 10-year yield. Is there a level that you and the team look at that spells crisis?
So I think when you're looking at levels specifically, most of the risk levels are normally around the long end. So thinking about those kind of pension funds, LDI funds, those sorts of areas that we've previously seen blow-ups in before. And our estimations are that you'd need to see yields above 6.5% for that to be a real problem.
And that's on the 30-year?
On the 30-year. But what we think is that if we were to see yields approach 6%, that would already signal kind of panic. And you would start to see panicked actions, even if there was not necessarily any issues with liquidity, there would be challenges in other areas. So those are the real levels we're looking at. So we're still quite a long way away from actual issues of liquidity or issues of actual market stress. But that doesn't mean that it will not pose an issue in other areas, fiscal areas as well.
OK. So 5.24 by the close yesterday on the 30-year. So there's still a gap before we get to that 6%. But that's the level to look at. In terms of the inflation and growth story, 0.1%, the most recent data print. This is a stagnant economy. Is this stagflation? And if it is stagflation, do you call it stagflation at this point? And if so, does that stretch through the year?
So look, I think the challenge...
A deep sigh
Yeah,
there.
no, because I think the challenge is that inflation is running quite high at the moment, even though it has fallen 2.5%. I think the bank wouldn't be happy with inflation staying around these levels and drifting higher, as it likely will do in the next couple of months. And growth also is quite low. So when you take those two things together, you look at the kind of definition of stagflation, it feels like we're in that environment. But I think the question is about this growth outlook that we see. Is this because we have high rates at the moment, which are bearing down on the economy? And if the Bank of England continues to loosen the pressure, will the economy kind of bounce back? Or is it something that's kind of entrenched in the economy? I think that's the question that we're trying to answer right now. Because if it's about restrictive rates, that's less of an issue. That's not necessarily stagflation. That's more just where we are in the economic cycle.
So where do you think the MPC is on this then? How boxed in are they? Or is this a BOE now that can look at the data and say, we need to go harder and faster on cuts?
I think you can see that the BOE is starting to come to that view that maybe they might need to go harder and faster. But I think what for them is the real challenge is the data is not validating that view. We've seen already Andrew Bailey, and that was a couple of months back before we've kind of had all of these moves in gilt yields, was talking about the fact that the BOE could become more activist. We also saw the new member, Alan Taylor, also talk about the fact that he thinks maybe we might need to do some kind of preemptive rate cuts as well. So you can see people are having those views. But I think the challenge for them is voting on those views because we're still having services inflation well above 4%. Looking at wages, they're above 5%. So all of those data are suggesting that actually the Bank of England needs to remain gradual. But I think we can tell that they have this a drive, a desire to go a little bit faster. So I think they still have that cutting bias, which is important.
OK, so they have the cutting bias, but clearly the complexities are there. We didn't get time to touch on tariffs from the US and the linkages with the Fed's views as well. But thank you for coming through and walking through your analysis of the UK markets, economy and inflation, the impacts on the gilt markets, of course, and what it means for the BOE. Modupe Adegbembo, economist at Jefferies. There's plenty more coming up. Stay with us. This is Bloomberg.
Of course, the USA is the most important ally for European Union when it comes to security and also for the economical side.
I will try to anticipate cooperative relations in these fields. I think that both American consumers and European consumers, worldwide consumers, do benefit.
I still hope to convince the next U.S. administration that we have everything to lose from a collective trade war.
It's still, the geopolitical landscape and Europe as a geopolitical power in the world.
So we are very much looking forward to cooperation with the Trump administration.
Some of the new figures at the top of the European Commission weighing in on the EU's relations with the US. A key question, of course, as we count down to the inauguration of President Trump on January the 20th, on Monday, what it will mean for Europe. Here's a picture of the growth differentials right now between the Eurozone and the US and the gap that has widened. The leverage, arguably, that gives incoming President Trump in terms of his expected negotiations with the EU. Will he, and to what extent will he impose tariffs on this Eurozone economy, and what kind of impact will that have? That chart showing you, illustrating the white line, of course, the growth picture that's come through for the US versus Europe, not getting back the European picture to pre-COVID trends. That is the gap, and that is the advantage that the US will have in these negotiations, and of course the further impact of additional tariffs as well. Talking of tariffs, let's go and have a look at China. Data coming through suggesting that, yes, they did hit that target for 2024, but a reminder just of the pressure on the real estate sector, and then the additional potential headwinds, of course, of tariffs. Exports really driving the picture towards the end of the last year. The stimulus came and had an effect. The export engine is kicking into gear in China, but will that be derailed by potentially 60% tariffs, as Trump has propositioned? Next up, gilts. Let's have a quick look at what happened in terms of the moves around, of course, the sovereign debt of the UK. You have actually seen yields, particularly in terms of the 30-year, coming down just in the last 2 days by about 20 basis points. Will that be sustained, the modest relief that's come through after the rout that we saw at the front end of this week? That continues to be in focus for us and for investors, of course. The opening trade is coming up next. We're going to walk you through what's happening in terms of the Middle East, geopolitics, with a focus on the deal that could finally be implemented in terms of the ceasefire on Sunday. And, of course, we'll work through the data that drops at 7 a.m. in a couple of minutes on UK retail. That's coming up. This is Bloomberg.